So in other words, the feeling of the market, like in the credit crisis, the sentiment was down, across, all stocks were down, not necessarily based on fundamentals. Some companies were increasing their profits, but their share price was going down. That's a case of fundamentally their share price should be going up, but the overriding sentiment of the market, because the fear in the world was driving the stocks down. That's a classic case of stocks undervalued and particular industries undervalued. Making sense? Because really they should be up here, but because something else that's affecting the sentiment of the market is driving them down in a short term. Because the market is irrational, remember. It's irrational. So, makes sense? That would give you opportunities to look for companies that are actually really are worth. There's some companies that their net assets are worth more, well more than what their share price capitalization is. That's a classic case of finding a company that is undervalued. So what that means is that their total market cap, so let's say a share is $1 and there's 1 million shares, 100 million shares. So the value of the company is $100 million. That is their market capitalization, what the whole company's worth. And let's say they had net assets, the company owned net assets after liabilities of, say, $300 million. Would that generally be a good indicator of a stock undervalued, yes or no? Absolutely, because you think, what you've got to do is think like this. Warren Buffett, when he's investing, he's looking at it, a share, as if he's buying the whole company. Now, generally that's because he usually is, okay? So it's all right for him, the rich bastard, he usually is buying the whole lot. But even if you're not, you should be looking at it the same way, that you're going to buy the whole lot. So if you could buy a whole company that's worth 100 million, but its net assets are 300 million, you go, that's a good deal, isn't it? It should be worth 300, 400, 500 million, but it's not. It's undervalued. See how this starts taking effect? So you can do this research, or you can actually get one of the most successful people could have been doing is that one of my team is a very good stock trader, has been in the business for a long time, and he does the investor newsletter. Some of you would have it. We might post it, give you some free copies at times. If you'd follow some of the picks and that through the credit crisis, phenomenal success. And all he's doing is doing the same thing, looking for stocks that are undervalued. Their net assets are quite high and their stock price is low. And they have high dividend yields. So even if their share price doesn't go up, if you're making high yields and high return, you just sit there and wait and just bring in the rent or the dividends off the stock. So there's simple strategies without doing anything complicated other than just looking at buying fundamentally good shares. Okay? So that's how Warren Buffett does it. Stick to that, you'll go a long way. Reason I'm teaching you that is because when you're going to be share renting, one of the biggest keys to it is making sure you're putting yourself into positions that are fundamentally secure. Because the people stuff themselves up with selling insurance and this sort of stuff if they forget all fundamentals. And I'll explain what I mean by that. I've done well because I use a fundamental analysis and fundamental strategies, and then what I do is overlay sometimes short-term trading strategy over fundamentals. And I'll explain what I mean by that in a moment, but what it means is a way to profit insanely from the market where most people don't, because they don't get it. Okay, they're too caught up in being technical analysis gurus, okay, and they overcomplicate everything, and they just don't see the simple things. I like to see things very simply. Who's figured that out by now? Okay. Now, some people say I'll oversimplify things. I don't agree. The reality is I teach you the things that make you the money. What most people do is they overcomplicate things, and that's why they don't make money. Do you know what I'm saying? What a professional is someone that's able to make something that's complex simple. That's what a professional is. Tiger Woods. Pretty popular at the moment, isn't he? He's been a bad boy, apparently. Anyhow, but Tiger Woods is someone that can make a complex, difficult game seem very simple. Is that true? That's why he's the best in the world at golf. Okay? Because he can keep it very simple. Can stay out of the hot spots. Stay on the golf course. So, we're going to buy a share. Now, the second strategy you can look at, so the first strategy is really knowing when to buy a share and what price. If we simply knew this share price was going up and down between $16 and $19 just by looking at the past history of the share is the other thing that you would do. Look at its past history, where it's been. Highs and lows. In the paper, it'll give you the highs and lows for the last 12 months. That gives you indication straight away. High's been 19, low's been 16. You know if it's at 19, you're probably not going to rush out and buy it. Unless something fundamentally has changed that you say, now that's a good buy. So you go, okay, well, it's been doing this for a year, I'm going to wait till it comes down to $16 and buy it then. So what we're looking at here, strategy 2 is what you can do, jot this down, is called channeling. Shares can channel. In other words, this is channeling upwards, downwards, or sideways. Tell me, upwards, downwards, or sideways? What's this share channeling? It's channeling sideways, okay? 16, 19 is going sideways. It can channel down, it can channel up. So channeling, why I teach you that is because once again, if you're going to be doing share renting and selling insurance and things like that, then what you want to know is how to channel because it'll make it more profitable for you. It's like fine-tuning the strategy a little bit so you can profit more from it, okay? Because some people, the reason they don't make as much money is the way that I teach it. They just say, oh, covered calls, yeah, I know about that. What I'm actually teaching you and why it enhances your profit is I'm teaching share renting is just one part of this strategy. We're combining 6 or 7 strategies with it to enhance it. It's that synergy effect and fine-tuning that gets you above average returns. And I have George speak to you tomorrow, I think it is, and he will take what we're teaching here and he'll go through it again, but he's then going to accelerate it for you. Okay, how to fine-tune it even more and maximize the returns. So if you have a good sound knowledge of it, then you can progress to advance or fine-tuning it even more. So channeling is this. If a share went from 16 to 19, some shares might do this 4 or 5 times in a year. If you bought it here and sold here, then you've made, say, 20% on your money. The average person has just bought a share, they check 1 or 2 years later what the price is, and they might come bought it here, and they check back in a couple of years and it's back to $16, and they go, that was a complete waste of time. Share's gone nowhere. But if you've been following the stock, you might notice it's been running in a pattern 16 to 19, and you go, okay, well, I'm going to sell at 19. Most people here get greedy and think, I don't want to sell because it might keep on going. But you're saying, okay, you might preset your profit goals. You might say, in this case, once I make 20%, I'm out. As an example, once I make 30%, I'm out. So top investors often preset their goals, makes their decision for them. Because here, otherwise, emotion takes over. You've made your 20% and you go, oh, my rule is to sell at 20%. Oh, but maybe it'll just go a little bit more, and emotion takes over, greed kicks in, and that can cost you money. Okay? It's different if you're a fundamental investor and you go, I set my goal at 20%, but something significant has happened now to change my fundamental analysis, and I'm going to override my rule and make a new decision based on logic that I think I should hold the share then. That's a different choice to allowing emotion and greed, and then you start justifying why you should do it. So you could do this. You say, okay, next time I sell out, next time it's around $16, you preset to buy it, unless something fundamentally different changes. And you do this again and again. So you can get some stocks that the market think is hopeless because they don't go anywhere. Same price the year started, but it's gone up and down over the year. You've made 20, 20, 20, 20. In this example, you made as much as 80% on a flat stock that's gone nowhere. Does that sound good? That's just an example of by channeling. If that's just one strategy, you say, that's all I'm going to focus on is channeling. You can make good money out of that. A lot more money than the average person. The reason I'm teaching you, because I know most of you want to generate cash flow from share renting, it's handy to know channeling, because you're going to be doing a bit of that by renting shares. Number 3 is, the key is leverage. If you get good at the stock market, you're going to want to be able to put more money into it. So leverage is, let's say, as the example I gave you over here, 21st century member, 22 years of age, he wanted to get leverage, and he leveraged it up. He had $40,000 from a personal loan. He then got a margin loan, so he was able to double and increase his leverage, had $80,000 in the market, and increase his returns to be able to make $4,000 a month. Making sense? So that's leverage. But if you're going to have leverage, what else should you have? You should have insurance, okay? So jot down number 4. Number 4 is insurance. Most people, if you ask the average Australian, go out on the street tonight and ask the average Australian, do you insure your shares? And what's the answer going to be? No. Okay? Most people don't even know you can insure your shares. Once again, don't ring NRMA and say, I was at Jamie McIntyre's seminar, I said I can insure my shares. You can insure what? You don't do it through insurance companies. Once again, you'll do it through the brokers. Okay? So you can insure your shares. We'll give you some examples of that today. Number 5 is, so you leverage insurance. Then what we can do is, well, 1, you can rent out your shares. We'll look at that in just a moment. And 6 is you can sell insurance. Not only can you, here you bought insurance, here you can sell it, which is just the opposite. These 5 and 6 generate you cash flow. What you could also add in here, there's a couple of other strategies, is that you can make money when the share price goes down. Okay, if you want to say number 7 is one the way down strategy. You can actually make money when the share price drops. And you can make money when the share price goes up, of course, but even without owning the shares. So there are additional strategies I'm not going to go into, but they're really the opposite of what we're doing here. Okay? When you get to become an options trader, when you're buying options, you can make money whether the share price is going up or down without ever owning the share. Now that's important to know because you're going to be collecting the money off those people if you're renting shares or selling insurance. Making sense? Okay, let me give you an example of this. We go through this quickly and you'll start to see how that all works. Now I know people are different levels in this room. Many of you already studied the DVDs and sort of got a good idea of this. Some of you haven't opened your home study pack yet or haven't been doing your homework. So if you don't quite keep up with this, just watch the DVDs over and over again. Plus we're going to have Andrew come on after me to go into some more depth on it. You're going to learn some more off George on the topic tomorrow as well. So you're going to get your head around it. And then we're going to paper trade in a moment as well. That's the best learning, is actually do it. Once you've done it once, then you know it. You know how to do it. Okay, so let's imagine we draw a line down your page, and let's say this is you on this side. Okay, this is you and this is them. What we're going to do is buy, if we're going to rent out shares, we need to buy XYZ. We're going to buy a share, let's say we buy XYZ, we looked at that, I'm going to buy it at $16. If you're going to rent out shares in Australia, what's the minimum amount of shares you must have? 1,000 shares is the minimum shares, so 1,000 shares will cost you $16,000, or to buy 10,000 shares would cost you $160,000. Or if you have a margin loan, you could have 80,000, that would be a margin loan. 80,000 of it could be a line of credit out of your house like we talked about before. Okay? So it doesn't necessarily have to be cash. It can be line of credit and a margin loan. So if you own this share, you can do nothing with it and just wait once a year and collect a dividend. Or what you can do is rent them out. So if we were to rent them out, we could get paid some money. So we're going to look in a moment in the newspaper how to find out what the rental market is offering. But let's say you bought this share at $16. It's trading upwards above $16, and you can rent it out at different prices. You could rent it out at $16, as an example, $16.50, $17, $18. There's a whole different prices available. You can rent them out. You choose what price you want to rent them out at. In this example, I'm going to say you're going to rent it out at $17 and it's offering 44 cents rent at the moment. So what you can simply do is you do this via a broker. Not all brokers are accredited to do this. So you only use certain brokers that can do this, or you can use our brokers if you want help. And so you just simply make the phone call and to rent out your shares for the month of, say, December. Okay? So what you do, 1,000 shares, if you rent them out, how much would you get? 44 cents, 1,000 shares would get you $440. 10,000 shares, 44 cents would get you how much? $4,400 for the month. Is that good, yes or no? That's good. So there's only 3 things that can happen. So you get, say, on 10,000 shares, 4,400. That is yours to keep. It's paid into your bank account, it's yours. No one can take it off you. So first thing that can happen is nothing happens. The share price stays where it is, pretty much, and you keep your 4,400. But Jamie, what happens if the share price goes down? What happens? Well, let's look at what happens. Let's say the share price dropped to $15 $50. You bought it at $16 on paper. How much has the share price dropped? It's dropped 50 cents on paper, is that true? But by renting it out, how much did you get at the beginning of the month? 44 cents. So that 44 cents you've got, it's really only cost you, on paper only, 6 cents. So it's actually added as a buffer. It's reduced your paper loss. And if you fundamentally bought this stock and you're happy to stay in it long term, you're not worried about that. You're happy, you bought it at 16, you think it's at 20, it's worth a lot more than that. You just sit and wait. In that case, if the share price goes back to $16 the next month, you're back in front again. Okay? So the third thing that can happen, what if the share price goes up? Well, the share price goes up above $17 before the month expires, the trading month expires, which is generally the last Thursday of each month. Generally last, unless there's holidays. So it's not the calendar month, it's the last Thursday, generally, of the month. So what would happen then is that if the share price went up to $17, your share price, your stock would be what's called exercised. What does that mean? It would be sold. So in the stock market, they use complicated words to make sure the average person can never figure it out. Okay? The world works like this. There would be no lawyers, accountants, or stockbrokers, or any of those professions if they use proper language. But by creating sophisticated language, that way people have jobs, effectively, because you have to try and decode it. So exercise means, if you hear that, some of you, oh, don't do that strategy, your shares might be exercised. It's like, holy shit, he didn't tell me about that. Does that mean I have to exercise them, or who's going to exercise them? All it means is they're going to be sold. Who really gives a shit? Do you really love your shares that much? You shouldn't. They're sold. So jot this down. Exercise equals sold in this case. It's just going to be sold. At what price will they be sold at? At the price you rented them out at, that you chose to rent them out at the beginning of the month, remember? You chose to rent them out at what price? $17. So the price you chose to rent them out at is the price they would be sold at, only if the price goes above $17 in that month. Okay? Or if it's above $17 at the end of the month, it's definitely done. It can sometimes go up and down and not be exercised. But if it's above that at the end of the month, it's definitely going to be exercised. So it means it's sold. So if it's sold at $17. What does that mean? You make an extra $1 per share profit. So on 10,000 shares, you make an extra $10,000. Less your brokerage fee is your only cost. Plus, do you still get to keep your rental money? Yes or no? Yes. So is that a good deal? Yes or no? And that's why this strategy is very popular. It's very popular. Now, some people say, oh, here's what will generally happen. If other professionals out there, accountants or whoever they are, if they don't understand a strategy and you go to them all excited, I'm going to do this, I'm going to have a great life, I'm going to become wealthy, I'm going to rent shares or do this, and they don't understand it, they're usually not likely to say to you, remember they're usually charging you for their time and their services. If you ask their advice, they're usually not going to say, it sounds like you know more than me. I'm going to bill you, but you know more than me. They're usually not going to say that, are you? So what will happen is they will dismiss it or say, oh, that sounds risky, you better not do that. So they, out of ego or significance, they make out they know more than you. Who's following what I'm saying here? That's how human psychology works. Most people aren't going to be honest and say, shit, you know more than me. You better charge me and teach me how to do that. Most people won't do that. So you don't want to get caught I'm excited and then rely on other people. In other words, you know more about this than the majority of people. So you want to speak to people that actually understand it. Because how many people, if you think about it, how many people have been talked out of things in life that's cost them a lot of money? Okay? Missed out on a lot of things because, so listen to other people if you want, but just make sure you listen to the people that actually understand the strategy or understand what you're doing. Because most people have a lot of fear. That's why they're not doing anything. The ones that get somewhere in life face their fears and actually go and do something, but they be intelligent about what they're doing, think about what they're doing, practice, keep it simple, away you go. Making sense? Quickly teach that to your buddy in 30 seconds each. Teach back and forth. I'll take a couple of questions, then we're going to pull out the paper and do it ourselves. Okay, I'm just curious. Does anyone have any questions out there? Does anyone have any questions so far? Okay, we'll just take a quick question down here. Yep, far away. Shh.
Jamie, in most of the property presentations, it all says residential property. Only Conrad last night on one of the slides had mentioned commercial property, but nor you nor Conrad talked about commercial property. Is there something wrong with them? Is there,
Yeah, no, it's a fair enough question. Generally, the reason I don't, I've invested in commercial property before, but not a lot, so I don't have a lot of expertise in it. Generally, residential is obviously a more suited market for the novice investor. Commercial is probably more of an advanced strategy, so there's nothing wrong with it, but it's different fundamentals and different expertise you require. So there's nothing wrong with it. You can make a lot of money out of commercial, and more, I guess, would you say, middle-class investors actually go into that field now because it is more accessible. So there's nothing wrong with it. It's just that I don't know whether some of the other property speakers might mention a little bit about it. I don't know if there's any commercial property course just on that strategy itself, but that's the only reason I haven't done it. Conrad doesn't focus on it either, but generally residential is, it's a fairly safe bet. Yep. Question? Yep.
Can you just briefly explain a margin loan and how it works?
Yeah, sure. So a margin loan is really they should just call it a share loan. It's you have a property loan for a property, a margin loan is a loan for shares. How it works is pretty much they will loan you the money against particular stocks. So it's only the biggest companies on the ASX, Australian Stock Exchange, that you can borrow against. Okay, not all shares will they give you a margin. Before the credit crisis, they would generally give you a margin loan up to 70% to the value of most stocks. Now, after the credit crisis, the leverage on most stocks has shrunk, and a lot of stocks they won't even loan you money for because the banks have got nervous. So therefore, you'll find it's much more difficult or impossible on some stocks. So how it works is pretty simple. You go to a stockbroker, they'll give you an application form. Just go to 20thcenturybroking.com if you want. Click through there and you'll be able to access an application form, whoever they're using, the different banks that do it. And it's pretty simple finance. And then you use that account, and then you'll be able to buy stock through your stockbroker, and they would know on your account you have a margin loan for X amount, and whatever stock you want to buy, if that particular bank loans money against it or that particular provider, then you'll be given, let's say you want to buy $160,000 worth of shares in this example, 10,000 of them, and you had a margin loan pre-set up for $500,000, say. Okay, they'll probably do that, anyone $500,000 to set up. You'd be able to draw down on that margin loan when they do the trade. And generally the rule is this, jot this down, the rule for margin lending is generally 50-50. Never go above 50% leverage. Never go above 50% leverage. You can go up to 70% leverage. Now in a house loan or an investment property loan, how high can you go up to? Generally 90%, 95, 100, 106% even in the boom times. Why? Because property by the banks, it's something they can feel safe, safe as houses, so to speak, where the share market is not considered as safe, so they won't give you as much loan. They will give you up to 70% on some companies max. Now, you can do things where you can borrow up to 100% on shares as well. And Justin will speak on Monday about that. You would have saw Justin on the home study. There's different leverage things where you can insure the portfolio, where you can leverage up. So, for instance, I invested $1 million in the stock market recently, and it cost me out of my own pocket $120,000. Okay? So I didn't have to put the $1 million cash in, only $120,000. And that was prepaying interest for 3 years. Okay, that's something like 3.8%. So think about this. If you could borrow at 3.8% for shares, capital protect it for 3 years, so my bet is the market will rise over that 3-year period. If it rises, I make money, as long as it rises more than my interest costs. If it doesn't, all my loss is my interest. And my interest loss is already tax deductible, so it's only a portion of that loss. So that's a way where you can get massive leverage but minimize your costs. So once again, you're pushing up your returns and you're lowering your things. So you can do what's called structured products. Okay, Justin's the person, he'll teach you about that. But otherwise, general margin lending. So let's say you were able to draw down on it, you want to buy 10,000 of these shares. Stockbroker knows that you have your margin account set up with them, and they will say, okay, you'll put $80,000 in your own money, and 80,000 margin loan, 50-50. And that's why you do it. So you don't have to use as much of your money. And that 80,000 you might have drew out of your line of credit of your house, as an example. Okay? Does that answer your question? Yep. One more quick question.
Yeah, what I don't understand is debt service ratio. So would you be able to touch up on that and explain it a bit?
So debt service ratio for
Property?
property?
Yeah.
Okay. Very good question. So debt service ratio is really what a banking term. So I don't know whether did Conrad talk about that last night?
Yeah, but he sort of went over it very quickly.
Okay, so what I'd recommend, he'll go into some more detail. I'll speak to the finance guys. But basically, debt servicing is banks will have their different criteria of how much debt you can service based on your income. Okay, and that's how they'll base it. So your debt servicing ratio will be based on how much debt you're borrowing, what's your income, and what's their current debt servicing ratio to do it. Okay, then what we call LVRs. Okay, an LVR is like how much will they borrow against the asset, 70%, 80%, 90%, etc. Does it make sense? So all you really need is that question. If you're ever getting finance, the finance broker, they can find that out for you. Or the bank will come back and say, this is all we're going to loan you. Make sense? Yep.
You're talking about using leverage.
Yep.
Isn't there a problem with that if you get a margin call?
Exactly. So with leverage, there is a problem. It's a double-edged sword. So you've got to, if you're going to use leverage, you have to be aware of it. That's why we have the rule 50-50. So what that means is that if you're going to use leverage in the share market, the general rule is you'll only ever leverage 50% maximum. Make sense? So in other words, if you're borrowing $160,000 worth of shares in this example, then you would only borrow $80,000 and you'd put $80,000 of your own money into it. That way, that reduces the chance of a margin call because the market would have to crash a long way for you to be margin called. Still, it's possible to get a margin call. So the other thing that we suggest, if you're going to be using leverage, what was the other strategy that you want to learn? Leverage and insurance. So you're using leverage, I'm going to suggest that you should, in most cases, have insurance. And you'll be taught that, and it's on the home study, etc. So you can insure yourself. And then I was talking about the example, like, say, with Justin, with protected products, where they're inbuilt protection. So I borrowed 100% almost, prepaid the interest, which cost me effectively over, 3 years, 4%, say 12% up front. So effectively, I've got 88% leverage, really. But if you take out the interest, 100%, but it's already inbuilt protected. So yes, it's a very good question. If you've got leverage, it's a double-edged sword, so you want to be able to minimize a margin call by not going over 50% leverage, and ideally have insurance in place, so it doesn't matter. So I'll explain some insurance later. Okay. Now, some of you will be familiar with Storm Financial. Now, hopefully no one intimately is fulfilled with that, but Storm Financial, what they were doing, which I don't understand why, they must have had very good salespeople, how they got people signed up for these deals. Well, basically what Storm was doing is they're making a lot of money, I know they were doing that, is that they were getting people to buy into branded managed funds, in most cases 100% leveraged, okay, with no protection. Not like what Justin does where it's a protected fund, no protection. And then they were charging outrageous fees, like something like if you borrowed $1 million, they'd say, let's draw your money out of your house, and then let's say you draw out $1 million out of your property, and then they'll double that up into another $1 million margin loan, and then they'll put it into a leveraged fund, which might get you $2 million worth, all up. So you're leveraged upon leverage, no protection. But they had a strong agenda to increase the amount you invest in because they were charging fees of, I think, 6-7% on the total amount. So let's say you invested, you invested maybe 300,000 or 400,000, it's leveraged up to 2 million. 7% of 2 million is what? 140 grand charged up front out of your account. So it's a very good deal for Storm. And clients still made a lot of money because in the boom market, if you had $2 million leverage and the market doubled, you've now got $4 million. But then what they would do is, okay, consultants go back, leverage it now, let's leverage this up again. So they can get another 140,000 in fees. And then the problem is if the market didn't keep on going, it all comes crashing down and people got their line of credits exposed, and a lot of people are going to lose a lot of money or have lost a lot of money over that. Okay? And that's what the whole ASIC investigation and everything like that. But that was going on for ages. So, but that's, if people invest in that, it's simply a lack of education. Because if you're educated, one, you wouldn't do it with them, because you'd look at their philosophy and go, yeah, some of that sounds good, I can go and do it myself. Why pay 7% fees? You could do it yourself and save yourself 7%. And if you want to be sure, go and buy insurance. It's probably only going to cost you 3 or 4%. You save yourself money and you protect it. And if you're in that, you would have made a killing when the market crashed. You would have cleaned up. But see, that mistakes like that occur from lack of education, not being financially educated, and dealing with salespeople. Because they're biased. Their agenda is to get as maximum fees as possible. So of course they're going to sway you into something, because that's the problem with the financial services industry. It's biased, commission-driven, and there's a lack of ignorance around consumers about money. So it's just a recipe for disaster. And that's why I'm a critic of that industry. And that's why I love stirring them up. Okay? And that's why I love to reshape the industry. One of the reasons I'm starting a lot of coaches, we talked about that at lunch for some of you, is that there's 22,000 financial planners in this country. They don't have a lot of value, most of them. I'd rather have trained people who are financially educated, financially empowered, motivated, licensed, that can sit down with people and educate them, empower them, and provide them with resources so people can be self-empowered to take action themselves, just like what you're doing. I think that's a better value service than sitting in front of a slick financial planner that has no idea about money and has been trained to try and flog you investments. Okay? That's the difference. So anyhow, I'm speaking to the converted here because you're educating yourself. People say education is expensive. How expensive is ignorance? Who's already lost tens of thousands of dollars from ignorance? Raise your hand. Okay? It can be a very costly lesson. Education is one of the cheapest things. I mean, the challenge in this country is most people don't value their education. They're too cynical. They'll spend 50, 100 grand to go to uni and will whinge about spending $3,000 or $4,000 for a financial education course. It just doesn't add up, does it? Where I spent hundreds of thousands of dollars on my education, my real life education, because I realized university cost me a fortune, delivered me very little in real life terms, but this sort of education got massive value from it because you can really put it to work. Okay, let's move on. You'll have some more questions in a moment. So what we're going to do is let's look at renting out some shares. So grab the newspaper in front of you. Everyone has a newspaper. We're going to quickly paper trade, and then Mr. Baxter will come and teach you some more. So on the, if we can put this up on the screen, guys. What we're going to do is take the theory here, the example, and we're going to look on your newspaper. And we're going to look at how do you find out how much you can rent a share out for. Real life examples as of this paper is December 1st, 2009. So what I'm going to suggest to you, December is generally not a good month for renting shares. Why? Tell me. Christmas, so it's a short month. Short month means you're going to get less money. It's also, we're already now, it's December 5th today, okay? So that would mean that there's only a couple of weeks left in the trading month. So pretty much December, as an example,